Okay, good morning or good afternoon. My name is Stacy Gorkoff. I'm the VP of Marketing at INETCO. I would like to start off by welcoming all of you to this exciting webinar. The webinar will focus on the 3 T's of payments modernization. With us this morning, we've got Mark Borbis, who is the VP of Product Marketing at INETCO. Mark has extensive knowledge and many years of experience, not many years, but many years of experience working within the payments industry, and we're very, very excited to have him here today. And with that, I will turn it over to Mark. If you do have any questions during this presentation, if you look up on top of your bar there, on top of the bright top bar, you will see the ability to actually enter those questions through the through the audience chat feature. If at any time you do have those questions, we are definitely going to address them at the end of the presentation, so feel free to enter them, and I will definitely acknowledge them at the end. And with that, we'll turn it over to Mark.
Great, thanks, Stacy. Okay, hello everyone. We're here to talk about payments modernization today, and which is really kind of a fascinating topic, because I think if you looked back 10 or 15 years ago, you would have thought that everything that had been done in payments was already done, and it was just about optimization and efficiency. And boy, it sure has changed a lot in the last 5 years. So we're going to spend a lot of time talking today about a couple of things. One, we'll go through the payments landscape and just look from a high level at what's shifting and what's changing, who some of the new players are, and look at how the ecosystem around payments is transforming. Because I think one of the biggest changes is that we're seeing very different value chains being created in the payment space now, with new players in the mix, and with, in some cases, old players that we've come to love and expect that are not in some of the newer value chains as well. So really kind of interesting to look at the ecosystem and how much more diverse and lively it's become in the past 5 to 7 years. We'll then take a look at a couple of different approaches to payments modernization, because if you're a bank or if you're a processor or involved in clearing payments or even at a network level, there's a lot of different strategies you can take here to cope with payments modernization. Everything from a kind of all in with both feet right away approach to a wait and see approach. And I think we're going to look at a couple of those different options and what the impacts of them are. And then finally, we'll get to the actual topic of today's webinar, which is the 3 T's of payment modernization. We'll look at the importance of being able to track payments, the importance of being able to troubleshoot payments, and the importance in having a platform in which you can implement a variety of different tactics and strategies to complement your payments modernization initiative and to get additional value out of what you're doing on the tracking and troubleshooting side. And then, as Stacy mentioned, we'll finish up with some Q&A. So let's start off by looking at the global payments landscape. I think the biggest thing about this is the payments really is a hidden, and I put hidden in quotes because I don't think it is hidden. You see it reported, but it's a hidden source of revenue for banks. When you think about what a bank does and where your revenue comes from, you often don't think of payments as such an important part of the mix. But it's a 40% share of bank revenue in 2014, according to McKinsey. And there was substantial growth in payments revenue in 2014 over 13. So we're really looking at a pretty significant growth in volumes. And the interesting part about this as well is that it's not just when you look at the overall mix of revenue here, the transaction-related revenues are actually growing faster than liquidity-related revenues here. So it really is a story driven by volume, a story driven by more payments. So the conclusion that McKinsey came to in their study, and this is where the data that you're seeing on the slide is from, is that the industry should continue to see healthy growth after what they considered a pretty extraordinary year in 2014, where payments revenues rose 9% to $1.7 trillion. So the good news is that we're looking at payments in the backdrop of a growing environment where our business cases for investment and for change should get some tailwind essentially by what's happening in the industry. McKinsey also expects the payments revenue to continue growing at about 6% annually. But what you're going to see, and I believe this is on the next slide, if not in the subsequent slide, that there'll be a rebalancing of these revenue sources, and that there's new disruptive forces in the payment space. And so these revenue sources within the bank will come from different places, but also the mix between the bank, the revenue that you're acquiring as banks from payments versus those that alternative players are providing is also subject to a lot of change and rebalancing as well. Okay, so really, I guess the net story that we want to tell off of this is that as in 2013, the growth in 2014 resulted primarily from an increase in transaction volumes, not from margin growth. So not from doing things less expensively or growing revenue on the base of a cheaper payment, but really just an overall volume story. And we'll get into more of the layers of that as we go along here. This chart looks at the growth in transaction volumes, both overall but broken down by different payment instruments. And there's a couple of stories here. There's growth, obviously, across all the different instruments, with the exception of check, which we see declining and expect to see declining. And really, this is much more of a U.S. story than it is a rest of world story in terms of usage. But there is overall growth here. So we're not just replacing check volumes with other payments types or moving the P underneath the shell, as the old game works. We're actually growing volumes overall as checks are declining. And the other point that's really interesting to me is looking at the debit card growth, because as we've seen, there are tight regulations around the world on debit cards. The regulations in the U.S. have really tightened up, especially in the last few years, in terms of the fee income banks are able to earn off of debit, the routing rules. We've seen major changes in the UK landscape and the rest of Europe in terms of how debit card transactions are handled and what the business model is around them. And yet we continue to see steady growth in transaction volume on the debit side, indicating this continues to be a really important part of the mix from a consumer standpoint, and something that we really need to think about on the payment side. So against this backdrop, we've got lots of volume growth. We've got some volume shift happening within the traditional instruments. We've got an environment where we're making more money from a revenue standpoint. And guess what? Everybody has noticed, right? So the payments ecosystem is really transforming. And there's a couple of themes to this. We'll talk about a couple of different things. One being, there's a lot of venture money going into fintech and into disruptive payments types. And so, PayPal is sort of the granddaddy of the alternative payment space, but payments is the core of Alibaba's business. It's the core of becoming the core of Apple's business. It's very critical within Amazon. Facebook has their own options here. And so we're really seeing a new battleground emerge for payments, where we have fintech startups, we have large investors, and we have tech giants that are investing in payments and seeing this as a strong revenue source, but also as an important way to control or exert influence, at least, over the customer relationship, and really wanting to own that relationship. Now, the second part about the non-bank competition that we're seeing is that they have de novo infrastructure. So in many cases, they're not starting with the legacy environments that many banks are starting with. They're not starting with the heavy regulatory elements that have driven many banks' decisions. And they've had the benefit of seeing all of us go through PCI over the last 10 years and emerge out the other side, and really can get a handle on exactly how they need to secure data and where they need to secure it, but still give themselves lots of flexibility around how they use it. There's another element to this here, though, too, which I kind of call the Uber benefit. There's a number of journalists that have looked at Uber versus taxi services in various geographies around the world, and what they seem to have all kind of come to is that the Uber essentially allows drivers to take the cream of the crop, to skim off the higher profit, higher revenue rides, leaving taxis to handle some of the more difficult rides, the ones where customers may have special needs, where the rides may be particularly long, et cetera. So a lot of these new entrants in fintech as well can focus on the profitable elements of the value chain and really try to carve those pieces out, because they're really not subject in many cases to a lot of the same regulation and other elements that a traditional bank would be in this environment. And so that's a theme that I want to bring up, because we're going to come back to that a couple of times, that how to really make sure that the best business is not being skimmed off by others, leaving you to handle the more difficult, high regulatory business. So the new entrants and the new ways to pay have really moved payments from being more of a backwater, if you will, to a space that has a lot of dynamism, a lot of startups, a lot more investment than just about all the other areas of banking put together. Another way to look at it, you may have heard the term unicorns, which are startups with values of $1 billion or more. Over 1/3 of the world's 37 financial technology unicorns focus on payments. So this is really definitely a space that's attracting a lot of investment and interest. In the first 6 months of 2015, fintech startups have already raised over $12 billion from venture investors. And the other piece is that there's also a lot of M&A activity happening within the payment space, where some of the traditional payment processors, which used to be infrastructure owned and used by banks, are being acquired by private equity. So we've seen large investors spending billions acquiring processors and offering very significant amounts of money for players in the market. Companies like WorldPay and First Data are out there as well and very active in the space. The second element, so the first element of that ecosystem really is a huge influx of money and looking for new ways to do things and looking for ways to disrupt the payments value chain that already exists. Very closely related to this are some really significant disruptive technology advances. So the new technology is driving innovation and change. And consumers are expecting much more tailored experiences and a lot less friction in their payments transactions, perhaps, than they have been accustomed to in the past. And this is putting lots of business pressure on the various players in the ecosystem. So we have more devices, we have more ways to pay, obviously, and I think that's probably pretty straightforward for most of you who are looking at this space where we have smartphones emerging, we have notion of NFC payments, we have EMV coming to the U.S., lots of different ways to pay, lots of different e-wallet technologies out there. We're also seeing a lot of players begin to try to enter the market faster by using cloud computing, by using open standards, by creating or leveraging APIs. We're also seeing regulatory pressures on traditional players in the payment space to open up APIs for new entrants. So very similar to what we saw in the long-distance telco business many years ago, where the incumbent players were forced to open up their network so that new players could ride on their rails. We're seeing the same kind of pressures happen in the payment side. And I think there's an interesting analogy and lesson for looking at what's happened in the telco space and making sure that you're not just the core plumbing provider in this mix, but that you're actually able to offer your own set of value-added services alongside some of the new entrants. The other piece is payments innovations are being treated as key product features, and this is the one that kind of amazes me. You know, when you look at Apple announcing a new phone with this Touch ID capability and the ability to pay with it, and seeing payments, as kind of a sexy new product feature on a smartphone is such a transformation from where we were 10 years ago. And so while there's all this attention and innovation going into payments, then there's also a simultaneous pressure to almost make us forget about payments. And this we kind of come back to Uber, where you leave the cab and there's no discussion of how much money was paid or anything else. It's transactions automatically handled behind the scenes. I think we'll see cases where electric vehicles, for instance, pulling up to charging stations will be able to automatically negotiate payments on our behalf. And so at the same time, payments from a retail standpoint are becoming much more transparent and almost hidden as well, and that's part of what's possible with some of the new technology we're carrying around. When we look at this from the consumer side, because we always have to remember that payments is a two-sided market where you need enough demand on the consumer side and enough product and merchant availability on the supplier side in order for payments to take off. Consumers are looking for fast, secure, convenient digital payment mechanisms. The delight that you still see when someone uses their smartphone to pay at a Starbucks off their loyalty card is quite something, and there's that attraction for that fast and secure and convenient payment type. It's also personalized. If you look at what Starbucks is doing, it's coming off of your loyalty card, and the customer's recognized, and their favorite order is often ready even by the time they walk in the door. And I think that's the thing, is that consumers are looking for more catered solutions that align with their habits. So there's this opportunity to take what is kind of the typical end transaction in an exchange where you hand over your credit card and you pay, and turn it into something that actually delights the customer and make that payment kind of a fun and interesting transaction for your consumer. So we've got lots of new players and technologies. We've got high consumer expectations. And at the same time, we've got some pretty substantial constraints in the ecosystem around what we can do. The economics around payments typically are very strong, but often it's looked upon as an area where we've made a sunk infrastructure investment, and now we need to get the most out of that infrastructure. And that attitude is running right up against the fact that now is the time when we need to make a lot of investment in innovation. And so there's a lot of budget constraints, and there's a mindset that needs to shift within many banks to be able to compete in this new payments ecosystem. We're seeing erosion on transaction margins simply as larger players are getting into the mix and able to offer transactions at lower cost. But we're also seeing new entrants whose business model isn't necessarily to make money off their transaction fees. So they're able to really lower the transaction fee cost in order to make money in other parts of their business, whether it's through advertising or consumer acquisition or special offers, et cetera. So the traditional economics around margins on a transaction, which have already been under a lot of pressure, are under a different set of pressures now by players who may not care about hitting a certain margin target. We talked a little bit about standards and regulatory requirements, but the big things here to me are the EMV shift, regulatory pressure in some environments for banks to actually open up APIs for things like account opening to outside sources. We're seeing this happen in Europe. Social media becoming a player as well in terms of executing payments, or at least facilitating payments through social media, or commencing a payment transaction there. And finally, just again, we've got so much more data that's now coming into the enterprise around how these payments are being used, and it's a different type of data than we've seen in the past. There's a lot of work that has to happen to be able to really understand, for instance, are you better off offering your own e-wallet as a bank, or are you better off partnering with one of the key players, whether it's a Samsung or an Apple, to use their wallet? And there's always going to be a trade-off there between customer convenience and customer relationship versus where you're actually able to acquire money in this chain. So that's a little bit about the ecosystem, which I think is dynamic, it's changing, it's interesting, and there's a lot going on. And so really when you look at this from the bank perspective, the key question is, how do you remain competitive in this space? And this is one of these easy statements. Well, you transition payments from a business cost to a customer-centric business. And that's very easy for me to say. That's a very challenging thing to do given the attitude and the mindset and the investment thesis many of us have had behind our payments business for the last decade or more. Payments have been really seen as a cost of doing business rather than as a business themselves. And I think this is transforming. It's transforming perhaps in the corporate payment space first, or perhaps has always been seen as a potential business there. But on the retail side, I think we're seeing a lot of change here as well. So banks that have had limited funds for discretionary investment have had to focus on cost optimization rather than revenue within the payments channel, and have often kept many payments developments to the bare minimum required. This is going to have to change in order to compete in that new ecosystem. We have to figure out how to give customers an experience that's similar to what alternative payment providers are offering, or is even differentiated from what an alternative payment provider is offering, to avoid having some of the best business and the best customers creamed off. I kind of called this the Uber effect earlier, but I think there's a real good analogy that can be drawn there. The second is to look at things like perhaps you have an e-wallet option yourself, but there's also options out there like Apple Pay and Samsung Pay. And your natural instinct might be to offer the customer whatever payment option they want, but how close are you to the capabilities that are offered in those more sort of horizontal or generic wallets? And do you have a natural fee or revenue advantage built into your e-wallet product that could really allow you to retain your customers or acquire new customers on your service? So But part of it is not to necessarily assume that the innovation coming in from the fintech space is going to be the best option for your customers and that you want to adopt it, but to really compare it carefully against what you're running internally and to see whether you have natural product advantages you want to leverage. Most of us have a payment switch. Most of us have more than one payment switch. And a big part of this exercise is thinking about how to build around your legacy switch, how to implement new features on more flexible platforms that really kind of complement what you're already doing on your core switch. So perhaps you want to look at some of the more atypical vendors in this space, like NCR and FIS, who maybe have not been on your list of switch providers or transaction platform providers. But this ongoing transition to digital payments technologies is going to put a real strain on legacy systems. And I think there's really a choice to be faced here between, do you continue to try to build new features within the legacy platform, or do you try to wrap around it and try to unlock new revenue streams? Because the many steps that you actually have to take to initiate and settle a payment require a lot of intricate technology, a lot of orchestration, a lot of trust to the underlying platform, and it may be that you want to keep the basics that are running well today in place in your legacy environment and begin to wrap the new services around that and look for those opportunities. At the same time, I think you're going to have to start looking at how you modernize at the core as well, because eventually you're going to hit a wall in terms of trying to wire new payment systems into your legacy, and you're going to have to look hard at how you want to shift and change that legacy environment. And the final piece in terms of remaining competitive is you've got to fund these projects from somewhere. And one of the key areas is looking at ways that you can reduce expensive silos and point solutions that are rife across most banks' payments environments, and use that as a way to fund not only a modernization initiative, but also a lot of the innovation that you'd like to do on top of it. The second part of this, though, is really, again, looking at this a little bit more from a process perspective. So the key here in terms of remaining competitive is finding a way to deploy technologies that allow you to scale smoothly and to handle the growing transaction volumes that are required to roll out your digital banking strategy, and to acknowledge that you're going to be handling a lot more transactions and a lot more diverse set of transactions than you have been in your payments environment. And to look at not only how to deliver the functionality, which is always the first thing we think of, is how do I deliver the functionality, then how do I deliver it securely, but also how do you deliver it reliably? So how do you make sure that your new payments instruments feel as reliable and solid to the customer as your traditional instruments? And how do you operate them with the same, or at least the same order of magnitude of efficiency as you operate your existing payments environments? And, it's not going to be as easy, for instance, or as efficient to operate a mobile payments environment perhaps as it is to operate your traditional debit card environment, but you should be able to get pretty close in terms of the efficiencies you get by thinking carefully about the tool set and the processes. The other core element is that a lot of banks struggle even today with getting visibility into their legacy transaction environments and being able to track and trace payments and isolate where things are going wrong and be able to see what their volumes are and what the mix of transactions are, and being able to do analytics on those systems. And I guess one of the key things we'd advise is as you're thinking through your payments modernization and executing, to build in the visibility you need to monitor and manage and analyze those payments flows. Because it's only going to get worse if you don't actually tackle that problem now. As they grow, as they come from more sources, as they become more diverse, it's beginning to become increasingly important to get that visibility. And it's probably visibility you lack today, or if you do have it, it's cumbersome to get it. It takes special skills, it takes special tools, it takes things that you can't run all the time to be able to do that. And finally, amidst all this, we need to be able to recover our investment costs as quickly as possible. Because keep in mind that even though we're trying to shift people's mindsets from an investment standpoint from payments as a cost of doing business and something we try to run as efficiently as possible, We also want to be really clear that we're building new products, we're achieving new customer scenarios on top of this infrastructure, and that's really the second way that we get a return on investment from this. So our first area of ROI from a modernization initiative is simplifying, streamlining, eliminating or reducing the need for point solutions and silos. That's kind of the operating efficiency part of the argument. The second part of it is, what does this platform now allow us to do in terms of agility, time to market, and acquiring new customers and revenue streams? Okay, so now we get into the part where we look at all the different strategies out there. And this is interesting because I think as you look across the banking landscape, whether it's in the U.S. or it's around the world, you'll see all of these different approaches in play, and they're all very valid. I obviously have some preferences on my own front on this one, but some of the strategies are literally maintaining status quo. You may decide that payments is truly a cost of doing business. It is not the key thing that customers come to you for. It's something they expect, but it's not something they expect innovation on. You may not really want to own a significant chunk of that share of wallet, and you're okay to let some of it go. And so you really just want to manage and optimize costs and run your existing infrastructure as long as possible. Having said that, you really will want to look for efficiencies here. You'll want to look for ways to ensure that as you've got these legacy environments where perhaps the skill sets are dwindling, that you're maintaining and ensuring you've got enough visibility for the next generation of people who are going to be taking over and monitoring and managing these systems. The second approach, kind of swinging to the other side of the teeter-totter, is you may want to do a full platform replacement. And there are banks out there that are doing that. They're making that huge IT investment. They're taking on that risk to really rip and replace their payments infrastructure because they have decided that payments is core to their strategy. It's core to how they execute. It's core to how they work with customers. And their customers expect that innovation and expect them to be shoulder to shoulder with an Apple Pay or a Stripe or any other option out there. The in-between option, the kind of Goldilocks in this one is putting an intelligent front end or wrapping your legacy environment. So being able to deploy front-end services and APIs that work with multiple services, multiple systems, so that you're both extending the life of your legacy system as well as adding on new capabilities and adding them in a modern set of technologies where you can get widespread developer skills and really leverage a lot of best practices in doing this. Fourth option, you just may want to get out of the business. You may want to move to a managed payment service where you're not putting all the capital investments into this innovation. You're relying on someone else to do it. And in that model, really what you're saying is, I want to keep pace with the industry. I don't need to be ahead. I certainly don't want to be behind. And I want to trust an outside vendor to take this piece of my business forward and keep me basically even with the market. That's a very viable approach as well. The last one is kind of a different flavor on the intelligent front-end option, which is running a hybrid environment and tolerating legacy for some of your payment streams, but building new components and streams alongside it. So here you're really migrating from a legacy switching environment towards a payments hub and a single integrated system. But what you're doing is running two platforms in parallel for the conceivable future. And each time you look at a new payments technology, you really look at the business case for, does it make sense to build this on the new platform? Should I build it on the old platform or adapt the old platform? And also, you can start to make the business case for migrating pieces of payments functionality out of the legacy environment into a new hub. So, no surprise here. I think we're seeing most banks take a controlled transformation approach to their modernization, really kind of going at that hybrid approach down at the bottom there. But I wanted to outline all of these strategies because we are seeing all of these at play across the industry. There is a common thread, though, across all of them, which is there's a huge pressure to still continue to achieve operating efficiency improvements throughout this. there's also an increasing need for really getting visibility across the transaction flow, because for any of these options, whether it's doing a full platform replacement or outsourcing your payments, the question of how do you get visibility into what's happening is a critical part of that equation. If you're going to outsource, how do you maintain visibility? How do you get the data that you want for analytics? How do you ensure that if you do want to change service providers in a year or two, you still have enough infrastructure and data built up in your own system that you can make that transition smoothly? If you're doing a full platform replacement, you sure want to be able to know what's going on before and after. And if you're taking the hybrid approach at the bottom, you may have good visibility into what's happening in the legacy environment, but now you need to be able to look at how transactions are moving through the new environment and interacting with the old environment as well. And this is where we get into our 3 T's of payment modernization. So these are 3 elements that we consider really important considerations in your payments modernization initiative. And more importantly, they're things that we see a lot of banks perhaps that are not thinking about. These are the issues. When you think about an iceberg, these are the issues that happen underneath the surface that you may not be thinking about as you're focused on new functionality, competing and making the transition and making the business case. Part of it is also just making sure that transition is going to be successful. And so these 3 areas are really aimed at doing that. The first one is tracking. Tracking is the first element of what we call a managed payments modernization strategy. You need to have the ability to track an individual transaction or a group of transactions from initiation all the way through to completion, both in the front office and in the back office environment. And this is important for a whole number of reasons. You can think about it purely from a technical perspective. It allows you to see how things are behaving and to quickly identify issues that are impacting customers, and that's important. It's also important for building trust in the system internally. It's also important for being able to benchmark whether you're able to settle payments at the same rate that you are with the traditional payments environment. They're important for being able to see whether your fraud rates, your compliance rates, and all these other elements are consistent. So it's core to being able to benchmark and really understand as you go through a modernization initiative, are things unfolding the way that you expect them to? And I can't overstress the importance of being able to know about issues in your payments environment before your customers do, especially when you're increasingly stacking your services up against de novo infrastructure that is being built by a huge amount of venture investment. You need to be able to show that you're as fast and nimble and agile and responsive to your customers as some of those technologies are. And so some of the things that are core to tracking is capturing all the digital transactions in your ecosystem, getting a big picture view of the payments life cycle, being able to do that regardless of the protocol that's being used, whether it's web services, whether it's a legacy ISO 8583, whether it's ISO 20022. I know there's a better way to pronounce that. It's escaping me this morning. And being able to correlate those pieces. Sometimes you're going to initiate a transaction via a web service call or an API call, or one of your partners will, and it's going to transform itself several times as it goes through your environment. It's going to shift to an ISO 8583. It may settle as a SWIFT transaction. In any number of different formats. The idea is to capture every one of these transactions, though, in one place across channels. So whether the customer is initiating that payment from mobile, from within the branch, from a corporate banking application, from a point-of-sale terminal. And the faster you can capture this data and the more cleanly you can capture this data, the faster you're going to be able to make sense of it. And so this is an area where relying on the applications you're purchasing or building to get at this transaction data is something I'd encourage you to think carefully about, because as you look at modernizing your environment, you're going to need to figure out how to get transaction data out of all these systems. And I guess my key thing would be, is that a problem you want to solve a dozen times or 24 times for every different platform you're rolling out and every different service? Or do you want to solve it once by finding a common denominator, universal way to get at that transaction data? I'm obviously going to advocate for the latter. I think you want to just solve this problem once and rinse and repeat on it, and not have to think about capturing transaction data and doing analytics on it, and how that is a unique requirement for every project. This is an enterprise standardization opportunity. The second the second element of a managed modernization strategy is troubleshooting. You need to have a simple way to pinpoint issues, whether it's across legacy environments or modern environments, regardless of the number of moving parts involved, because there are quite a few and there will be more. Troubleshooting allows you to identify which component or which service is responsible for customer issues without a lengthy and a costly finger-pointing exercise. Because the challenge is you introduce more technology to your payment stack, and as some of that is modern and some of that is legacy, it's inevitable that when things go wrong, people are going to start pointing at what's new, or they're going to start pointing at what's old, or they're going to start pointing at what's changed. Everyone's going to have their own theories, and the last thing you want to do is waste a bunch of time with infighting, because this payments modernization initiative is economically difficult within a bank, but it's also politically difficult. And if you're the sponsor behind a massive modernization approach, to some degree you're walking around with a target on your back, where if things do go wrong, if it disrupts a legacy system, if it disrupts an existing value chain within the bank, and something does go wrong in the system, the reaction is going to be strong and swift internally, and you want to be able to really troubleshoot these issues and demonstrate where things are going wrong. So this means being able to monitor those end-to-end transactions in real time so you can see where things are going wrong. Understanding the relationship between the transactions and the core IT systems that underlie them. Because guess what? People are going to start to forget how a transaction gets executed and which moving parts are involved in it as you go through modernization initiatives and as you introduce new payments types and new value chains. So you want to get those real-time notifications, and you want to have access to tools to be able to quickly search for the root cause of the issue. Being able to get at logs, being able to get at alerts and search functionality, and being able to do that without having to think about which tool you have to use for which system, without having to turn on diagnostics and wait for things to happen. Again, much like you want a universal way to get at the transaction data and to track the transactions, you want a universal way to be able to troubleshoot across your payments and to be able to isolate issues. Before we get into the third T of payments modernization, I wanted to bring up a quote here from an analyst at Celent, Gareth Lodge, who's been doing a lot of work on the payment space and looking at banks' payment modernization initiatives from a variety of different angles for a number of years now. And he points out what I think is a really interesting paradox, which is that bank systems were designed to secure and store data. In fact, if you look at most of the effort that has been put in over the last 10 years on the payment side, a lot of it has been around PCI and around protecting data and creating defense in depth around that payments data, rather than sharing and using it. And the fundamental principles behind a lot of alternative payments providers is much more on the share and use side than the secure and store side. And so we have this interesting divide between how things are evolving. But I think what Gareth points out very well here is that control over the data and that security and storage is a critical differentiator that banks bring to the mix. But we need to find better ways to work with it. We need to find better ways to analyze that transaction data as the transactions are executing, because this is really where we have the opportunity to affect a transaction as it happens, to improve the odds it's going to be processed effectively, to catch fraud as it's occurring, to spot those opportunities to delight the customer or to evolve a relationship with them. And so I think what he's really pointing out is this notion of how do we find better ways to work with data and enable our partners to work with the data as well. And that's kind of a good segue to talk more about tactics here, because the key is appropriate tactics, to me, are the third element of a managed modernization approach. And this has less to do with the operational visibility that we've been talking about through the last 2 points, and more to do with the new capabilities you can harness, because the idea here is to transition and become more of a data-driven organization. And as you're becoming more data-driven in the payments environment, there are so many more interesting opportunities that come into play, where you're not just thinking about how to report on how many payments were executed and how much money you're making and where they came from, but you can begin to analyze where, when, and how customers are interacting. And you can use this data to optimize your service levels as part of a branch transformation project. You can use it to drive revenue growth. You can use it to shift business from one channel to another, to find that elusive source of revenue within your mobile channel or your online channel. And most importantly, to figure out a way to improve stickiness and loyalty with the customer. Because the key is using the data that you've got here that is afforded to you by doing good tracking and troubleshooting to actually begin to better analyze what your customers are doing. Also to look at this as an opportunity to shrink your reporting analysis time. You may be, and business users and channel managers throughout the bank may be accepting week-old data, month-old data today, and trying to make decisions based on that. Imagine the possibilities that are there if you're giving them real-time data or giving them data that is intraday even, and how that's going to change the way that the channel can do business. The other piece is that when I look at most payment spaces and look at the analytics and reporting built on top of them, it is very IT-centric. So when a business user wants something new, they're picking up the phone and they're standing in a queue for a report to come out of the data warehouse team 6 weeks later. And there's this unhealthy dependency built because there's really only one way to get data out of the system. I would encourage you really to think about how you make your analytics and your reporting far more self-service as you modernize your environment. This can reduce the amount of IT effort it takes to run the payment system because you're not constantly handling ad hoc requests and queries. And it can also improve satisfaction across the user base within the bank when they have access at their fingertips to the data that they need. And the final piece, going back to Gareth's quote, is to really think about how a modernized payments environment with really good visibility allows you to do things in real time and do analytics in real time and respond to what customers are doing in real time, as opposed to our traditional approach of just looking at the historical data. And being able to actually begin to predict what our customers are doing and to really get ourselves up to the same level that a lot of the new fintech disruptors are, where they have a phenomenal amount of data around what's happening with customers, and they have platforms that allow them to respond in real time to that. So these are some of the tactics, and the main point for this is that I want to stress that the first two T's around operational visibility are critical sort of blocking and tackling parts of a modernization initiative. But I also want to encourage you that the buck doesn't stop there. Once you have that infrastructure in place for operational visibility, there's a lot you can leverage out of that infrastructure to improve the experience within the bank and the experience to your partners and your customers as well. So to summarize, just before we get into questions and answers here, a modernized infrastructure presents really significant opportunities to develop end-to-end solutions that address emerging customer expectations. These solutions are going to enable banks to retain what is a central position in the client relationship, and I think that's the key. We talked about the Uber effect of alternative sources creaming off some of our best customers. We want to keep them. We want to compete effectively over the long term. And if payments is core to your strategy going forward, you want to figure out a way to do it really well. And to do that, and as you're thinking through your modernization, you're probably not thinking through, as you're executing on your modernization initiative, to really think about tracking, being able to follow individual transactions, to spot issues before customers do, so that you're responsive, you're agile, you're extremely reliable. To be able to troubleshoot those issues very quickly internally so that you're achieving the same type of operating efficiencies that you're able to with a legacy infrastructure. And finally, being able to leverage that transaction monitoring infrastructure to do business differently. and to really be able to unlock a whole new set of tactics and strategies that have not been available to you in a traditional payments landscape. So the payments business is changing. We saw that at the beginning, huge changes in volume. And with that, disruption brings opportunities. Both opportunities for you to make a business case for investing differently in the payments business and thinking about it differently, but also transitioning it to a customer-centric business and moving it out of that sort of cost of doing business. And also building a strong and a new portfolio of tools that help you do things you always wish you could do in the payment side, but perhaps haven't been able to. And so really looking at this as an opportunity to transform and to change. And with that, we will open things up for questions.
Okay, thank you very much, Mark. That was a ton of information coming at you, but judging from the questions here, we're all processing it quite nicely. The first question that came in, what accounted for the growth in payments? Is it volume or margin?
It's definitely on the volume side. So there's been I think it was a 9% growth in volume, 2014 over 2013. So we're making more money at the top line, which is great on the revenue side because I think most banks are under pressure to grow revenue. So it hasn't been achieved through margin advantages or through cost pressures, et cetera. But I think margin is always an important part of the mix as well.
Great. How is the relationship between banks and vendors changing or shifting?
Yeah, this is an interesting one. I think that in a lot of different ways. I mean, first of all, vendors are one of the key sources of innovation available to you in terms of finding new technologies because they're working with a variety of different banks. They may be better tied into some of the alternative mechanisms that are out there as well. And so I think we're seeing a stronger degree of trust between banks and vendors in terms of bringing new technology in the payment side. I think the other piece is the introduction of APIs into the banking systems and it being easier to actually execute or trigger different payments or accounting opening transactions or other things like that, where as the walls of the bank open up, the possibilities for vendors in creating new solutions is expanded as well.
All right. What is your definition of a transaction?
Yes, there's all sorts of different definitions out there. When I think of a transaction, I guess I think about it as the entire life cycle. So it starts with the consumer or the payments initiator. It goes through all the different steps that it takes to move that transaction, both internally and through third parties, and all the different steps until it's complete. So I think about it as an end-to-end representation of the customer's interaction and all the different things that have to happen to make that work.
Okay. How do you justify the cost of tracing, troubleshooting, and tactics? Is it operational efficiencies? Is it more revenues?
It's a little bit of both. There's an operating efficiency piece of it, but I would also look at this purely from a risk standpoint. As you're going through a major transition like this in your business, you want to be able to manage the risk of that transition. Having visibility really allows you to get a handle on the risk and reduce the risk of that kind of transition. And then when you look at it from the revenue side, this really comes down to once you've got all this data on what's moving through your payments environment and this instant visibility, you can empower your business users to react far quicker to changing conditions and to do everything from change where an ATM is placed to create better incentives for customers to use your e-wallet instead of Apple Pay and things like that.
Okay. What are different aspects that define the Uber movement of the payments?
Okay, so yeah, I kind of referred to this notion of the Uber effect, which is really where typically new entrants to a market will look for the easiest, lowest friction business that they can acquire. And I think this is really evident in the payments environment where there are some types of payments that are really difficult to do. But at the end of the day, if you go down the road 10 years, you don't want to be stuck as a bank only executing the most complex foreign currency corporate payments transactions that large enterprises require bespoke systems for. You don't want to be in that business and that business only. And so I think it's really important to look at how you maintain the nice high margin payments business, the low friction business, and I think that really involves looking at how you make payments transparent, like an Uber does. I think it involves how you make them sort of pervasive and part of an application, and how you offer a really simple experience to the customer.
Okay. This next question has a couple of parts to it, and answering part 2 first might help. What are the 3 top features that are needed for a payment solution? That's question number 1. And number 2, are payment hubs in demand, and what is your view based on your global outlook and experience?
Okay, yeah, you're right. It's probably easier to answer the second one first. Yes, I think payments hubs are absolutely in demand. And payments hubs to me is less of a technology and more of a concept and a way to execute a transition. It's a way to think about the fact that you actually have a lot of different payments channels and a lot of different products and services that can fall into the payments umbrella. And a payments hub to me is really first and foremost about getting all the people that work in those areas talking together and working together to create a common vision for where they want to get to. And it's only then that you really get into the technology side of how you implement a payments hub. But to me, it's about getting corporate talking to retail, getting large value payments talking to small value payments, getting real-time talking to batch. All those different things are an important part of a payments hub strategy. Now, the first part of that question was the 3, remind me, the 3...
top features that are needed in a payment solution or a product.
Yeah. I would say, first and foremost is it needs to be incredibly reliable and resilient, because this is running stuff, and the expectations of our consumers around how payments happens is really important. So that resilience is critical. Second piece is I think you need to look at how you can build on it quickly and cost effectively. And those two goals are often in tension. But you want to be in control of your own destiny with this technology. You want to be able to add new services when you want and not be dependent on a vendor's professional services queue and specialized technologists to do that. And I think so the scalability is critical to it. I think the flexibility and the ability to add to it is critical as well. And then obviously I think visibility and the ability to do analytics on top of the data are really, really critical. So, and this is another interesting one where what we really expect a payments switch to do is to switch transactions. We don't necessarily expect it to provide visibility, or that's not the core thing that the developers perhaps built it for. But that visibility is so critically important, maybe even more important than moving the payment itself in a lot of cases.
Okay. The next question. In the digital wallet space, how big a factor is the float on the money stored? And will that drive more services merchants to having their own wallets?
Well, I mean, I think with the interest rate environment where it is today, I don't think the float is that big of a factor. You're not going to earn a heck of a lot of money off of the float from consumers' wallets. That could change, certainly as interest rates improve. But I think really, to me, it's more about if a customer maintains a float in their wallet, then you've got some notion of stickiness. You know that they're going to have to come back to spend that money at some point. People don't like leaving money unattended. And so I think float is a really important measurement of how important a customer considers your wallet, I guess would be the best way to put it.
Great. The next question, and this one might be a little bit vague, but it's around compliant. How compliant will be the changes? We might need a little bit more information on that question before answering that. I know compliancy is definitely something that we consider.
Yeah, there's a lot of different ways to look at compliancy. I mean, there's compliancy at the technical level between all the different standards and protocols that need to move around. There's compliancy at the regulatory level, and there's just internal IT compliance within the bank in terms of how they move on projects. So yeah, maybe the best thing would be to get a little bit of a clarification on that question, either through Bright Talk or through my email directly, and I can help you get to the bottom of that one.
Okay. This next question, and it's actually a product question, so I'm assuming that there are people out there that have downloaded. I know we have attached to this presentation both the Ineco Insight product sheet and the Ineco Analytics product sheet. The question is, do you only show aggregate views of transactions within the Ineco Insight product?
Really good question. No, we show detailed views of transactions as well. You can drill down to, at the core, we're capturing every individual transaction. And we often find that both from an operations standpoint and from a business standpoint, it's more useful to look at transactions in aggregate to drive decision making. But you can always get down to the individual transaction detail within both of our products and see what's going on. And obviously, in a troubleshooting context, that's extremely important. But also, when you're looking at it from a business analytics perspective, it can be really important to just get a feel for what all those transactions are, how many there are, and what they look like.
Good. Okay. And there was a follow-up question. Does Ineco Insight have the ability to track multiple protocols?
Yes. Yeah. So Insight is very flexible in terms of the decoding of different message formats and different protocols. We haven't met anything that we haven't liked yet, and we continue to add new flavors of payments transactions as well as just more general enterprise transactions. Because part of this shift towards payments hubs is we're seeing people begin to move away from a lot of the standard transaction formats to more web services, to more middleware and message queuing type of calls as well. Database transactions become an important part of the mix, and so we're present in all those places as well.
Okay. And then a question for Ineco Analytics. Is Ineco Analytics real-time?
So Ineco Analytics gets a feed of data from Insight. Insight is real-time. Analytics can get that data in what I would consider near real-time. So definitely multiple times intraday, typically once an hour, and have the ability to do it faster. But the analytics routines, et cetera, run about every hour or so today from an intraday perspective.
Okay. I think that's it for questions, and that's actually bringing us to the top of the hour as well. Again, a big thank you to all of you that have attended this session today. We really hope that you found it informative. We'd love to hear any feedback that you have. If you're interested in a demonstration of either product, I've just noted that I think the one Ineco Insight question seemed to open the dam to a ton of them. Please let us know. We are more than willing to take you through a one-on-one demonstration of either product. And with that, a big thank you to our speaker, Mark Borbas, as well. Thanks for joining us this morning, Mark, from Vancouver, Canada. It's an early morning for you. We appreciate you being here. And take care, all of you. Have a great day, and we hope to have you on our next presentation.
Thank you.